Hi there, this is Alvin from Dr. Wealth. Today we are going to talk about why TBU investors should start to consider investing in REITs as an alternative yielding asset that generates income for you, right? So as we know, the TBU rates have been coming down right, after the crazy rise in 2022 due to the rate hikes, and it reached at a peak of 4+% for the 1 year TBU. And since then, the start of 2023, we have seen the 1 year T-bills in Singapore started to come down, right? A more gradual pace. And as of the latest, which is in May, we are looking at about 2.12% in terms of the 1 year T-bills in Singapore. And this, if you ask me, is not a very attractive interest rate. And I believe that many investors would also agree. And if we compare it to, say, the long-term average inflation rate of 2.59% in Singapore, it cannot even beat the inflation rate. So that means that the purchasing power will eventually go lower and lower, right? And that is not how you want to protect your wealth. Okay, so definitely, in my view, T-bills now is not an attractive investment. So what next, right? So what we can look at is, of course, the REITs, and I've giving you 5 reasons why TBU investors should consider it. The very first reason is that you definitely get a higher yield, and that's the purpose, right? And on average, the REITs are giving 6.9%, those that are listed in SGX, and compared to the TBU's 1 year of 2.12%, you get a very big upgrade from there. Of course, it is not risk-free. They are not the same asset class, in fact, right? So T-bills are definitely much safer, and REITs do have price volatility, which means that prices may go up, go down, the properties may not do well due to different economic cycle. The REITs may also be impacted, especially what we are looking at is a higher interest rate that does hurt the REITs earnings after paying higher financing charges. That means there are also lower amount of dividends that's given to unit holders. Okay, so it is indeed higher risk, right? But my argument is that anyway, you have no choice. If you want higher yields, you have to take on more risk, right? That's one. But I think it's a more measured approach, not asking you to do very risky investments, but take a bit more risk, right? A moderate risk in order to achieve higher yield. That's where REITs will be able to offer you that. And if we take a look at the comparison between the volatility between REITs and regular stocks, you will see that actually REITs are not as volatile, right? So if you can orientate yourself, you can see the yield is definitely on the higher side on the vertical axis, right? The S REITs or the REIT indices are higher compared to a lot of other stock indices. And on the horizontal axis, on the right hand side, you'll see the volatility will be higher, right? On the left hand side, the volatility is lower. So you can see REITs again is more on the left side, which means that the volatility is more or less volatile, right, compared to many other stock indices around the region, and therefore it gives you a much more good risk reward kind of positioning with REITs. Okay, so you're taking more risk, but it's not going to be more risk than your regular stocks out there. Okay, so it becomes a very good compromise, right? Getting a higher yield, right, in exchange for taking a bit more risk. And if you don't want to pick individual REITs, there are REIT ETFs where you can just buy immediately and achieve diversification, right? So there are those that are based more in Singapore, right? The Singapore exposure, but there are also those that have REITs that are listed elsewhere, right? Have different geographical exposure. So it depends on where you want to expose yourself, how diversified you want to be, and you can see that there are also various yield that's stated in this table. Of course, check the latest figures in order for you to make a more informed decision, because all this information or this data is dated. So do check out. But nonetheless, the REIT ETFs are a very good way for you to diversify widely. Second reason is that there will be capital gains. It's not like T-bills. Definitely, there's no capital gain. You're just going to get back your principal plus interest at the end of the maturity for T-bills. Even no matter how the interest rate rise or fall, you won't really have that capital gains at the end of the day. But for REITs, it's different, because when the interest rates fall, you may see the REIT prices go up, right? All things being considered equal, right? We don't talk about recession and things like that. So in general, the REIT prices will go up as interest rate falls, and that gives you additional capital gains on top of the dividends that you're already enjoying. Okay, so if we take a look at the history of these REIT indices in Singapore, and you can see that over the last 10 years, largely the REIT indices have done better than the STI, right, which is our stock index in Singapore. Only in recent years, when the interest rate started to climb, right, you start to see that the REITs have a gradual fall, right, while the STI went up, right, heavily exposed to banks, which banks do better when interest rate goes up because their net interest margin expand. So you can see that is this cycle that you go through. But that's it. That means that REITs in general are not expensive, okay, because the prices have fallen. And the other bonus is that we all know interest rates are falling, probably not falling as fast as people expected, right? It's just crawling back down. But generally, that is the trend that is happening sooner or later. And that itself is a good environment for REITs once more. Okay? It may not fall back to the close to 0% interest rate in the past, but as long as the interest rates are moderated, not as high as like 3-4% during 2022, 2023, I think it's already a very good sign for REITs. The future is definitely brighter, right? There's the light at the end of the tunnel. Number three is that REITs do not have maturity dates, and that means that there's no reinvestment risk. Okay, so what is this reinvestment risk? For T-bills, when it matures, you need to roll over, right? That means you need to buy another new T-bills in order to stay invested. But when that happens, it doesn't mean that you always get the same yield as you have enjoyed previously, right? Just like in this case, the yield is dropped to 2.12%. And there will be a point where you realize that, okay, it's no longer worthwhile. I don't want to park my money in T-bills anymore. So this is what we call reinvestment risk, right? So the yield is just not attractive anymore for you to continue investing in the same asset. Okay, so for REITs, it doesn't have this issue because there's no maturity date to deal with, right? It's perpetual as long as it holds assets, hold properties that provide rental income, and you will always be able to pay out the dividends on an ongoing basis. Okay, so these are some differences, right, that you need to probably understand between T-bills and REITs. So both have regular payout. So this is why I say that it is REITs will be a good upgrade from T-bills, right, in terms of getting higher yields because they are very similar. REITs may give out dividends once every 6 months, just like you buy a T-bills every 6 monthly. Okay, so you also will have that kind of income that you can derive from these investments. And we talk about the maturity, right? So T-bills every 6 months or yearly depends on whether which version you buy. That will always have this reinvestment risk, whereas REITs do not have that reinvestment risk because it has no maturity. And the third is that the income potential usually is more short term for T-bills because of the maturity. Okay, there will be a point where, as we discussed just now, that you will not want to reinvest anymore. But for REITs, it's more for long term, right? You hang on to a good REIT, you hold it, and you get to enjoy the dividend payout perpetually. In terms of investment amount, T-bills you have to do lump sum. Okay, so there is a minimum investment of $1,000, and it has to be a multiples of that. So it cannot be any amount that you wish to invest. Okay, so it has to be in that kind of tranche, right? As for REITs, you can do lump sum or you can do dollar cost average, right? Nowadays, a lot of brokers will have this money investment plan. You can even invest as low as few $100, okay, every month and buy into REITs. Okay, so this is something that you can't do with T-bills. Okay, and lastly, liquidity. Because REITs are traded on the stock exchange, that means that you can buy and sell anytime you want to, as long as the exchange is trading and open for trading. And for T-bills, it is not traded on an exchange. Okay, it's an over-the-counter kind of asset. That means that you need a middleman to find a buyer for you if you want to sell it. In case there's an emergency for T-bills, you find it harder to liquidate. Whereas REITs will be a lot easier. Okay, so there are advantages looking at the REITs investment. And number four, REITs ultimately hold properties, real estate, and I know that many investors love properties, at least compared to other kind of stocks. It's a lot easier to understand, say, compared to, say, biotech. Okay, that is a lot harder. But for properties, you can see, you can touch, especially if the properties is in Singapore, you can even visit and find out how they are doing, right? So this is an example, right? These are properties, these 9 properties are the Heartland Malls that's owned by Fraser Center Point. I believe that these are properties that you have seen before or even frequent, as it is close to your home. Okay? And the benefit is that you don't even need to collect rent, right? Everything is taken care of. The property management is taken care of. Which asset to buy and sell. There's a professional management that handles it. Okay. And another benefit for REITs is that the rental income is not taxable, right? Whereas if you buy properties under your name, you would need to pay rental income tax. Okay, so these are some of the benefits that REITs get to offer. Okay, it's a no frill, simple kind of investment vehicle, and it's high yielding as well. And number five, the last reason is you should diversify your income assets. Okay, it's not about playing it safe, 100% put in ultra safe T bills. As you can see, it can't beat the inflation rate anymore, and the good times are over, right? So you do need to look at diversifying income assets, and one of the key thing is that the economic cycle is not consistent. Okay, so there will be periods where certain income assets do better. I give you an example, right? Since we're talking about REITs, so for REITs, it tends to do well when there's slight inflation and strong economic growth. Okay, so that is where rental increases, property prices increase, and that's where REITs increase in value as well. Right? So these are the good periods. And in contrast, T bills will not do as well. Right? So REITs will readily beat T bills returns. And there will be periods where REITs underperform, which we have seen in 2022, 2023, or even extending to this year, 2025. Right? It has not really recovered because interest rate, when they're elevated, that hurts the REITs. Okay? They tend to underperform. And that's why when interest rate is high, your T bills become more attractive, right? And now we are entering a period where interest rates are coming down, and you can see that T bills rates have already fallen, while REITs prices have not really recovered yet. Okay, so there can be opportunity where investors can take this transition, right, to enter the REIT market. So I would say that you can see the interest rate environment, the economic cycle are different, and therefore, to make your portfolio more resilient and robust, you should have different kinds of income assets, right? So like a multiple streams of income that do not all correlate to a particular economic cycle. Okay, so they should perform in different economic cycles so that your income is intact regardless where the economy is going. Okay, so that is one aspect that you should also consider. Not about 100% into T bills or 100% into REITs. More about how do you structure your portfolio into multiple streams of passive income. So these are the 5 reasons, and I hope that it is clearer to you now, and the value proposition that REITs can bring to the table, especially if you are looking at whether to reinvest in T bills, but not attracted by the low yields. Okay, you can now consider alternatives like REITs. Thank you for watching. I hope you have a better idea how to structure your passive income, and do like this video, subscribe to the channel, and I'll see you in the next one. Goodbye.